We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to The Long-Term Investor. I've been collecting questions from readers, listeners, social media followers, and I had originally planned to answer a question or two at the end of each episode, but it was feeling a bit forced, so instead I'm going to have the occasional mailbag episode, just like this one. This first one, it's primarily a mix of questions that are asked in response to past episodes, and I'll try to highlight when those come along. So let's just jump right in. This question was in response to episode 2, How I Invest My Money. This listener asks, can you elaborate on a house is a form of consumption? I get the arguments that buying a home is not an investment, but to me, consumption is spending $18 on a bottle of wine that quickly disappeared. Thanks for the question. I really liked this episode for what that's worth. It was based off a really popular blog post I had written, which I'll link to in the show notes, also called How I Invest My Money. And I'm glad this person agrees with me that the primary home really shouldn't be viewed as an investment, but instead it's a place to live. And in that same vein, I really don't think of my house as an asset that I'll ever tap. Sure, I'll probably build up equity over time that I might theoretically use in a retirement scenario where I'm downsizing, but I think it's more likely that if I downsize someday, it'll probably just be to a smaller place with a higher cost per square foot. Because that's what I'm seeing with most of the people I'm working with who are, quote, downsizing. So even though my house is on my balance sheet, I'm still not going to tap the value of my home, and I'm really just mentally accounting for it as consumption. I think of it as a use asset, one that's used but doesn't really have any monetary value. A car is a pretty good example of a use asset, the assumption being that you'll always need a car. And with a house, I'll always need a place to live. The other thing is that owning a home costs a lot of money. All the homeowners listening definitely know that. And I'm not just talking about property taxes or a mortgage. You decorate a home, you repair it, you remodel it, but it's just a place you live. Now, I don't list other use assets on my balance sheet like cars, but I do keep the house on my balance sheet listed at the purchase price, partially because there's a pretty healthy sized liability hanging out on the other side of my balance sheet. But I think even if I didn't have a mortgage, I'd probably keep it on the balance sheet, in part because one day at death, perhaps my kids are going to monetize that value, that part of my net worth. Good question. The next one is also in response to the How I Invest My Money episode. That one has been very popular, so if you haven't had a chance to listen to it, go ahead and go back and do that. This listener says, hypothetically speaking, if you inherited $1 trillion, would that change the way you do things considering how you invest your own personal capital right now? Well, I think $1 trillion will change just about anybody's mindset, but because I basically only own a single mutual fund that's 100% equities and globally diversified, I'm pretty sure that $1 trillion would change that equation to some extent, if for no other reason than I'd want to pay far less in fees than what the fund currently charges if I'm going to put $1 trillion into it. I mean, that's a lot of money for a fund company. I'd probably go to the fund company and ask for them to set up a separately managed account with a similar strategy, just at a much, much lower fee. As I said in the podcast, my existing plans to go to a 70-30 portfolio at age 50, unless we're in the middle of a bear market. But if I had $1 trillion, I probably don't need bonds anymore. The only reason I'd really go to bonds at age 50, to 30% bonds at age 50, I should say, is because I'm trying to offset a little of the volatility of ahead of retirement and try to reduce some of that sequence of return risk. So if I have $1 trillion, though, I don't know if there's a lot of use for me having bonds. So I'd probably just stay 100% stocks. I would probably try to buy an MLB franchise, and I would totally be the type of owner that just plows money into the organization, emphasizing championships over profits. So I'm not sure how much of an investment that would be, but I think I would do stuff like that. Maybe some other private investments on a smaller scale in different ventures that just interest me, where maybe I could also make some sort of a personal contribution. But whenever I'm having that classic if I won the lottery conversation that I think everybody has from time to time, I've always pictured it being closer to 10 or 20 million. And this person's talking about $1 trillion. So apparently my dreams are just boring. But a 10 or $20 million windfall, I really don't think would change my strategy much. Again, I might go to the fund company managing the fund I currently utilize and ask them to do an SMA or a separately managed account at a much lower fee. But I'd probably stay 100% stocks and probably still scrap the plan to ever buy bonds, just knowing that I'm going to outlive my money and try to take into account the people inheriting it in their time horizon as well. Next question. This one was sent to me in response to episode 8, Investing for Inflation. This listener asks, as a long-term investor who benefits from compounding, how does one also integrate the negative impact of inflation on the net result? I suspect that the rate of compounding is correlated to a great degree with the rate of inflation, which negatively impacts the return from compounding. Can you explain that relationship and impact? I rarely see mention of inflation when reading about the, quote, eighth wonder of the world, end quote, aka compounding. Great question. You're right. Most people, myself included, talk about compounding nominal returns, but what's really important are real returns, which are nominal returns minus inflation. That's what really matters. Inflation is going to lower your real return every year. So yes, it does act as a drag on the compounding of your long-term purchasing power. I think the most relevant place where we integrate the negative impact of inflation is in the capital market assumptions that are driving our financial planning models. So in our planning models, we currently assume a long-term average real return of 7% on global equities and a 1% real return on global bonds, both of which are largely in line with the long-term historical averages. And you could easily make an argument that real returns will be lower over the next 10 years due to either lower expected returns in stocks or bonds or higher inflation or maybe some combination of both. But longer multi-decade real returns don't deviate that much from the long-term average. So I think those are a really good way to incorporate inflation. And I like that we use real returns in our planning models, this framework, because it means we only have to predict one less thing. A lot of people will put in an inflation assumption and a return assumption. Really, it's that real return that matters. And if I don't have to forecast whether inflation is going to be higher or lower in the near term or over any period for that matter, I think that's a lot easier. I only have to make one assumption about the premiums stock provide above inflation. Next question comes in response to episode 11, Where to Save for Retirement. This listener asks, you spend a lot of time talking up health savings accounts, HSAs, but is it worth using an HSA if I might need to spend some of those dollars now? Well, it totally depends. If you're in a high deductible plan, you should definitely be using your HSA at a minimum just to get the income tax deduction. But if you know that you're going to need to use your HSA contributions to meet current medical expenses, then you probably should not be investing those funds that go into the HSA. As a rule of thumb, and circumstances always matter, but as a general rule of thumb, if you have money set aside for something to be spent in the next handful of years, that money really should stay in cash just to eliminate the risk that it's worth less than what you need it to be when you need it to be around, especially if the timing of an expense or goal isn't flexible. And when I talk about using an HSA as a retirement savings vehicle, that's really for people who can afford to leave their HSA contributions invested while paying for the medical expenses entirely out of pocket. And the other thing is that some people shouldn't opt for the high deductible plan just to get access for the HSA. And I referenced this in the episode. I have an equation that I think is pretty simple for deciding whether or not a high deductible plan makes sense, but it might be easier to digest in a written form. So I'll be sure to put this in the show notes. Basically, it's you choose the high deductible health plan if your expected medical expenses are less than the sum of the savings in monthly premiums, your employer contribution, and the PPO deductible. But if your expenses are going to be greater than that, you should stick with the PPO plan and just not worry about the HSA strategy. And in terms of trying to figure out what your expected medical expenses are, all the major health insurers have calculators on their website where you can enter how often you go to the doctor, or if you have prescriptions, or how many dependents you have, all sorts of good stuff that comes up with a pretty good expected medical expense that helps you plug into this equation and make the decision that's right for you. The next question is something I actually pretty commonly get over email. And I've been asked this question in so many different forms. I'm just going to shorten it here. It's basically boiling down to what's the ideal investment mix for retirement? The thing is that there probably is an ideal investment mix for every reader who's ever asked me this question. But without knowing the details of a person's situation, it's impossible for me to answer. It'd be a lot like a doctor prescribing medicine without ever seeing and diagnosing the patient. The way that we determine the ideal mix for someone's retirement is by creating what we call a living financial roadmap that considers where you want to go, and it also adapts to reflect your changing life situation and objectives. So I have a pretty good resource that I can link to in the show notes that walks through some of the inputs to come up with this ideal investment mix. But something I can say at a high level about people entering into retirement is that the biggest risk to any allocation and financial plan is something called sequence of return risk. So in the few years leading up to retirement and the few years immediately after retirement, assuming that's the point at which you're going to start drawing down from your portfolio, a bear market can really lower your portfolio's lifetime income ability if you're forced to take withdrawals while the market's down. So imagine you retire and your portfolio is down 20% the year you retire, the impact from those withdrawals is going to compound over a year, and it permanently impairs your portfolio to some extent. So for this reason, we typically recommend that retirees have 1 to 2 years of cash on hand so that you can spend from the cash if there's a recession early in retirement while you allow your portfolio time to recover. And the one last thing I'll mention about an ideal retirement mix is that the allocation you have on your day of retirement doesn't necessarily need to remain static for the rest of your life. The thing I see most frequently is that as people age and it becomes clear that they're going to outlive their assets, you really ought to adjust the time horizon for the portfolio to reflect your heirs' time horizon, since it's really going to be them that's ultimately spending some part of that money. But again, check out the link I put in the show notes. It lets you download a white paper that has some of the inputs that goes into how we come up with the ideal mix for our clients, at least. Next question comes in from a reader. It says, I noticed you lightly chimed in on Twitter about the CFA versus MBA, but I noticed that you have a CFA and CFP. Why did you get those credentials, and is one more valuable than the other? So there was an article on Bloomberg shortly after the CFA Institute released the CFA pass rates, which happened to fall to historic lows. And the article makes a pretty pointed case that the CFA isn't as good as an MBA. And I can't say a lot about getting an MBA because I don't have one, but the author also never got past the second exam of the CFA. So I feel like he's drawing some conclusions that aren't necessarily universal truth. So yes, I did lightly touch on it on Twitter. It's just not a black and white issue. It totally depends on the person. For listeners that aren't familiar with the CFA designation, it stands for Chartered Financial Analyst. And when I started the CFA curriculum, I was an investment analyst. So the content was super relevant to my job function. The curriculum, it's a series of 3 exams. They used to be given once a year, but I'm pretty sure now they're given a few times a year, although you all have to fact check me on that one. The website, it says that the average study time per exam is 300 hours. And again, this is also with the pass rates being pretty low. So when the May 2021 exam was given, the pass rates for the first exam was only 25%. Let's see here, the second exam was 40% and the third exam was 42%. So it's not just that the average person studying 300 hours per exam, a lot of them are failing and having to take them over. And I know in my experience, I studied more than 300 hours per exam. It's a lot of work. I feel like I just completely disappeared from friends and family for 6 months at a time. And while it could theoretically just take 3 years to pass all 3 exams, the pass rates suggest that most people don't do so. And in fact, the CFA website says that 20% of those who start the program actually complete all 3 exams. So the reader's asking, is it worth it? Is there a designation that's more helpful? In my role as chief investment officer, the CFA definitely comes in handy. I don't know that I would have gotten to where I am today without it. But that said, the CFP designation, which stands for Certified Financial Planner, is far more useful for providing wealth management and financial planning advice. So shortly after I'd finished the CFA curriculum, I started working with clients as a lead advisor. And so I sat for the CFP immediately when I was allowed to after the CFA. So you got to skip a lot of the courses if you had a CPA or a CFA. And so when I got that official designation, I signed up for the very first CFP exam I could take. And it served me really well over the past several years, really since I've ever taken it. And this person's asking if one designation is better than the other. In my opinion, the CFP is way more valuable if your primary function is that of being a financial advisor. For me, the CFA has probably personally been more important given my role as chief investment officer. But I would agree with this Bloomberg article that was referenced, and I'll drop that article in the show notes too. I think there probably are way too many people taking the CFA exams that shouldn't be, or at least they have unrealistic expectations for what the designation will do for them. Next question comes over email. It says, are there any best practices people should keep top of mind when they begin the refinancing process? Are there any checklist items that people shouldn't forget to do? Well, I think the most important thing to do is make sure the math of refinancing makes sense. Make sure it's really worth the cost, because there's all sorts of costs involved. There's appraisal, there's loan origination fees, there's recording fees and taxes and so on. And some lenders, they're going to require you to pay these fees up front. Others will bake them into the loan in the form of a higher balance or a higher interest rate. And there isn't like a right way to cover these fees, whether you bake it into the loan or pay them up front. You'll definitely want to crunch some numbers to make sure that the monthly savings is going to be worth the expense, especially if you're not planning to stay in the home long term. And I think there's a pretty simple way to calculate a break-even number that tells you how many months you'll need to stay in a home to make up the cost of refinancing. So you start by subtracting your expected monthly payment from what you currently pay, which is what you would save per month. And then if you add up all the total costs of fees, then you can divide that total by the monthly savings. So if, for example, your break-even number is 18, it's going to take you 18 months before you recoup your refinancing costs. Only after that 18-month period will you actually start realizing the savings from your refinancing. And a good rule of thumb is that you're looking to get a number of 24 months or less. If it's going to take more than 2 years for you to break even on a refinancing, it's probably not worth it. And if you're not planning to live in your home for as long as it takes to break even, then again, you're probably better off keeping the original loan than you are refinancing. Next question comes from a reader. I recently turned 70 and read that my generation are the biggest targets of cybercrime. Are there steps I should be taking to protect myself? Yes, there are. And they apply to people of all ages, because I think it really just boils down to common sense and a healthy dose of suspicion when you're doing stuff online. It starts with really just like think before you're clicking things. One bad click can drain a financial account, can expose you to identity theft, it can install malware on your device. So anytime you're looking at clicking a link, especially in an email, like double check the email address. It can differ by just a single character from the account of someone you actually know. Or you can hover your cursor over any links without clicking, because that reveals the underlying URL. And it probably will point out if it looks suspicious or not when you actually see the URL. You should definitely have your email's spam filters activated. And you can always call a company back. If you take a publicly listed number, if you call the company back instead of responding directly to an email, that'll pretty quickly classify whether or not it's a fraudster. There's other stuff, though, going around like texts, people who are mining social media posts for personal information so that they can make these attacks more targeted and more convincing. So you really do have to just be a little bit skeptical and think before you click. I think you should also use two-factor authentication wherever you can and be smart with your passwords. I mean, you shouldn't share your passwords either. And I think most people know they're not supposed to use simple passwords like 1234 or their birthday. But I don't think that people create as strong or hard to guess passwords as they really should. You really shouldn't have personal information in your passwords. I'm a huge fan of LastPass. It creates, it stores, it autofills the unique passwords. It does all these things across all my devices. And so I think finding something like that, again, LastPass, I think is wonderful. That's a good way to be password smart. The other thing I would say is just keeping your devices up to date. So most desktop and mobile operating systems, and also the applications within them, they offer these periodic updates, which frequently include security patches. So if you aren't doing these updates, you're basically working with old gear, and people know how to get past those security systems. You have to do the updates, absolutely have to do the updates. And when it comes time to get rid of an old piece of equipment or an old phone, you want to restore the device to factory settings in order to make sure that all the personal data is out of there. Another thing I think that comes up a lot is how people use Wi-Fi. So home networks, routers these days have gotten much more secure. They tend to have much stronger encryption settings, and they offer automatic updates that old routers don't do. So if you haven't replaced your internet router in a decade, that might be something to do at home. And then in public, I can't believe how many people use public Wi-Fi. There's a lot of people who set up decoy Wi-Fi systems containing the name of an airport or a hotel or a restaurant where you're trying to connect. You really should be tethering to your phone via personal hotspot if you have a smartphone. And it's one thing if you're getting on public Wi-Fi to check a sports score, but you really should not be getting onto public Wi-Fi to do any sort of financial stuff or even shopping because you're putting in your credit card. Once you're on public Wi-Fi, people can see what's on your screen. And that includes the Wi-Fi that you get on the airplane. A lot of people do stuff on the airplane Wi-Fi I'm just completely shocked of. So that's something to try to avoid. And trying just to think of a few more things, you can talk to your kids. I mentioned it's not just older generations. My 8-year-old, we talk to him all the time about activity on the internet because he's online more with his iPad, and we're constantly reminding them, hey, don't tell anyone your name. Don't tell anyone the name of your school or your home address. You never agree to meet anybody in person. I think it's just important to kind of reiterate that with kids. But maybe the most important thing of all this is we talk about what are some things you can do to protect yourself. Freezing your credit is pretty powerful because once someone has your identity, one of the things that they can do with that is open up all sorts of different lines of credit. And that's a real nightmare to fix. So if you put on a credit freeze at the 3 major credit agencies, this will prevent any new accounts from opening in your name without your express permission. So I think that's a really key one for anyone to do at any stage in life. So that's a pretty big list there. I jotted down some notes for response to this question. It's hard to remain safe all the time, but those are the things that came to mind as most important for protecting yourself. Okay, last question I have for today. This person writes in, I'm still paying off my student loans. What's the bigger priority, paying off my loans in full or starting early on investing? And this question actually came in prior to the last episode, which was episode 11, Where to Save for Retirement. And I've written on this topic in a bunch of different places in the past, most recently for the Wall Street Journal. So I'll drop a link to the free version of that in the show notes. But I also did an interview with Money that I thought was pretty good. So I'll put a link to that as well. When you're trying to optimize the amount that you pay down debt versus invest, I mean, you have to look at things like the interest rate, the term, the payment features of the loans, especially when it comes to student loans. The optimal choices are typically going to depend on the savings vehicles that you have available and the expected returns on the investments that you make. So there is what I think is a mathematical solution, but as I've said in the past, we don't live in a spreadsheet. Some people really like the idea of being debt-free. Others are going to prefer to optimize return. And maybe the best and most realistic thing is that you do a little bit of both. So with that in mind, here's sort of my personal preference on how to prioritize paying down student debt versus investing. The first is that you would contribute to your employer-sponsored retirement plan up to the match. So as I talked about in the last episode, that's free money. You make $100,000 and the employer offers a 3% match. If you contribute $3,000, they're going to put $3,000 in your account. So that's the fastest way to double your money in finance. The second thing is to create an emergency fund. And I realize this isn't invest or pay down debt, but you really can't ignore the importance of having some money available for the unexpected expenses, really regardless whether or not you have debt. But if you have debt, you should still be allocating some portion of your excess savings to an emergency fund. And I really do think that does take priority over any extra debt pay down, any additional principal pay down that you do, or any additional investing that you do. It doesn't have to be a lot, but something to the emergency fund. After that, I would say you'd pay down the private loans with the highest interest rates and the least payment features. So if your interest rate's above, say, like 8%, it probably makes sense to allocate your remaining savings towards the extra principal payments on these, what would be pretty costly loans. If your rate's between, say, 6 and 8%, then maybe you'd allocate half of your extra monthly savings before investing more. And at this stage, I wouldn't be prepaying down federal student loans, in part because private student loans typically charge a higher interest rate than federal student loans. But they also tend to offer less payment features that you'll find with a federal loan. With federal loans, you can have payment and interest deferments while you're in school or returning to school. There's loan forgiveness for certain professions. There's income-based repayment plans. There's balance forgiveness at death. And there's even situational loan payment forbearance sometimes. So private student loans sometimes have a few of these features, but it's rare they have all of them. And it's the lack of payment flexibility and features that also makes the private loans maybe a better candidate for consolidation and refinancing. When you have a federal student loan that you consolidate and refinance, a lot of times it loses the payment features. So you don't necessarily want to do that. Beyond that, I would say then you start to think about maxing out your employer-sponsored retirement plan, in part because it's often the cheapest place to access a diversified set of investments. And this is plans like a 401k, 403b, 457. Once you've maxed out that, then maybe you're going to, if you still have extra monthly savings, then maybe you're going to start prepaying down the federal student loans with those interest rates above 6%. I think if you have a federal student loan with an interest rate below 6%, I'd probably be making the minimum payments on that debt until it's repaid and just allocating any excess cash flow to your other goals, like investing for the future or building an emergency fund or maybe even buying a home, buying a car, whatever. The lower interest rate federal loans, they're not super restrictive in terms of cost, especially when you look at it compared to the potential return in the stock market. There's one exception to this rule. If you work in a profession where your loans are going to be forgiven after a certain number of years, Just make sure that you follow the rules of your program to ensure that your balances are going to be forgiven. And again, I think this order of prioritization, it largely ignores some of these emotions that people feel with debt. Because again, we're all human. We don't live in spreadsheets. And the psychological draw from being debt-free is really hard for a lot of people to ignore, especially if you have larger than normal student debt loans. So I do think that sometimes you can do a little bit of both, but there's no perfect answer. It's just important to remember that the choice between paying down student debt and investing doesn't have to be a mutually exclusive decision. A mix of both is probably going to be what's mathematically and emotionally the best solution for you. That's all I have for now. Keep submitting those questions to me, and I actually am going to start having guests a few episodes from now. So if you have any questions related to tax legislation coming up, that would be perfect for my next guest, who I'm going to keep secret from now, but I'm very excited about. If you're enjoying the show, please leave me a review. I really appreciate reading those, and they also help people find the show. As a reminder, you can go to thelongterminvestor.com for free resources, show notes, and a place to submit questions for me to answer on the show. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.